everyone, and welcome to the 119th episode of the Veritas Fact-Finding Series. And today I'm joined by the very distinguished Professor Robert Knechel. Good morning, Robert.
Good morning.
In each episode of the Fact-Finding Series, we go on the ground to speak to industry professionals in an unscripted, candid, live video format to discover how we can make better investment decisions. In this series, and with everything we do, we believe the facts empower investors, and the better information leads to better investment decisions. If you're watching and you like what you hear, give us a like and follow us at veritascorp.com. By way of background, my name is Anthony Scilipoti, and I'm the president and CEO of Veritas, independent equity research firm based in Toronto, Canada. Proud to say, celebrating this year 24 years being 100% employee owned and operated. Quick disclaimer, this broadcast is not to be taken as investment advice, and participants or employees of the Veritas group of companies may own securities discussed in this broadcast. While we love all our guests, this session may contain forward-looking statements, investment opinions, and comments that we may not agree with at all. Although I can preface by saying that's going to probably be very difficult to happen. But in any case, now I want to just give you a quick snapshot here of Professor Knechel. So we're really honored to have this. And I met Robert. I was speaking at the fraud conference put on by my alma mater here at U of T. And Professor Knechel was one of the presenters. And he heard me speak and came up afterwards and said, wow, we share so many similar views. And then I heard him speak later, and we agreed that we had to carry on a discussion. So with that spawned a relationship, and we've been discussing auditing and the accounting profession, and he sent me his book published in 1998, and which I'm going to touch on in a moment. Quickly, he's the director of International Accounting and Auditing Center located within the Fisher School of Accounting. He holds an appointment at the University of Auckland as a professor of accounting research. He's on the board of the Foundation for Audit Research in the Netherlands, and he's a member of the Standard and Emerging Issues Committee group of the Public Accounting Oversight Board. So he's a member of the PCAOB. He recently completed a term as Accounting Review's senior editor. He served as the senior editor of Auditing, a journal of practice and theory, and his research, of course, has been published in numerous different important accounting and audit journals. And he was honored in 1995 as Outstanding Educator in Auditing Award given by the auditing section of the American Auditing Association, and he's received the honorary doctorates not just here in North America or US, but in Norway and the Netherlands. So I want to kick this off, Robert, and I want you to tell us about yourself, how you got into accounting, why you decided to specialize and become an auditing professor. We'll then talk about the many different forces that are at play and coming, perhaps, as you alluded to in our pre-discussions and in discussions we've been having, that we may be hitting a tipping point for the audit profession and audit in general. And then we'll talk on some of the current trends, and whether it's Trump's auditor that's being put aside because or chastised by the SEC. It's unbelievable. Can you imagine doing audits without having any paperwork, just basically faking the whole thing? And I want to take this home because our client base and those listening in are going to be investors and regulators here in Canada, auditors as well. What do stakeholders need to do to deal with this situation, and how can investors better arm themselves to essentially avoid the bombs? All right. So with that, Robert, why don't you tell us about yourself and how you got into accounting, and we'll go from there.
Well, I have to be honest. And by the way, thank you, Anthony, for inviting me to do this. I'm very happy to be here. I'm sitting in Florida near the University of Florida. Obviously, through modern technology, we can do this. And
just amazing.
The one positive thing that came out of COVID, I think, is the ability to do these things. Well, I'm an accidental accountant, to be honest. I was at the University of Delaware as an undergraduate, and taking lots and lots of different credit hours. And the university said, you need to graduate. You have way too many credit hours and no degree. So I asked some friends and said, where can I get a job? And they said accounting. So I took all the accounting courses in the last semester and became an accountant and went to work for Arthur Andersen in Philadelphia. It took me about 2 years to figure out that was really not what I wanted to do. It was really nothing to do with the accounting firm. It was everything to do with me. I went back and got a PhD, took my auditing knowledge, which actually I'd learned a tremendous amount from that experience, even though it was only 2 years, and applied it to a research career that's now in its 45th year. And so that led me to the University of Florida, which led me to a lot of international activities. And as I say, the rest is history. So I consider myself very fortunate in this because I didn't plan much of it. It just kind of happened. And as Anthony knows, I just got back from 2 months in New Zealand, where I've met with the regulators down there as part of my position at the University of Auckland. We're looking at a profession that is in transition on a worldwide basis. And so we see the headlines. We know what's going on in the sense of the really bad stuff. But what we don't necessarily know is the challenges behind the scenes.
You know, I want to quote from the opening of your preface in your textbook published in 1998. The auditing profession has entered a period of rapid and extensive change, and accountants are struggling to formulate a strategy for coping with the economic forces confronting the profession in the, at the time, 1990s and beyond. And so I could take that same quote, I think you'd agree with me, and we could change that to in the 2020s and beyond, and it probably still relevant. So why don't we start with sort of laying the key things that you're seeing today in the profession that you sort of touched on that are making us reach this sort of so-called tipping point.
Well, by the way, I hadn't read that in a long, long time. Whoever wrote that was pretty smart, apparently. And the book is now in its 4th edition, and about the 5th edition is probably coming out in early 2025. And that book, I mean, I should give you the background there, because in the 1990s, we're in an unregulated audit environment.
There was no PCAOB yet.
There was no Enron and WorldCom.
There's no CPAB either in Canada.
Right, and so Enron and WorldCom were on the horizon. The PCAOB was not even a figment of anyone's imagination. And what the firms were dealing with is how to better build in an understanding of business risk into their audit models. And I found that to be an absolutely critical activity and spent a lot of the 90s doing this. And that's how the book came about, because I found the books that were being used in universities were very insufficient when it came to actually understanding the risk concepts that auditors really needed to get into. Because business models became more complicated, technology became more complicated, global operations became more complicated, and the old-fashioned way of ticking and bashing numbers, which are basically balance sheet numbers, was probably not adequate. You know, that I'll give you one little story about that. One of the things I did during that period was I flew into Prague to help one of the big, at the time, 5 firms implement some of these new methods at a bank that was being privatized by the Czech government. If you remember back then, we were coming out of the Cold War and the Iron Curtain had come down, and the country of Czechoslovakia had split into 2 countries. And what do you do when you split a country in half when the government owns everything? Well, there were 4 banks. So the Czechs got 2 and the Slovaks got 2, and they had to divide everything up. And when I was helping implement this new methodology, it was a fascinating experience. And the story, what I remember most was sitting through a meeting where we were supposed to be talking about the gold reserves, which everybody wanted, of course.
Yep.
Nobody wanted the government loan guarees. Everyone wanted the gold reserves, but the Slovaks were sitting at a table saying, we won't talk about any of that until the Czechs return a 14th century triptych that they had moved from a church in Slovakia to somewhere in the Czech Republic, and the Slovaks wanted it back. That's not the kind of audit problem I'm used to dealing with, but it's very interesting. You fast forward to where we are today, and it's not so much the forces have changed, they've magnified. When I say tipping point, we've about a year ago, actually, I gave a speech to IFIAR, which is the International Forum of Independent Audit Regulators, which is essentially the PCAOBs from around the world. And there's 55 countries that have audit regulators. And they asked me to talk about the crisis in the human resource supply chain in the accounting profession and in auditing specifically. And That's a very complicated, as I started to dig into it, the simple answer is that the firms need to pay more. Well, that's actually not that simple at all. It's cultural, it's demographic, it's firm business models, it's technology, it's regulation, it's all kinds of things that have basically come together in a perfect storm, in my opinion, to potentially tip us into a whole new profession. And I realize your audience are mostly investors, but clearly auditing is an important component to the financial reporting supply chain on which you're going to be relying. And if it falls down on the job, as we've seen too many times, then there's often knock-on effects that can be extreme, can be very extreme. And so some of the trends we're seeing in auditing now, for example, is the Big Four in the United States is hiring almost 50% of their new auditors from places other than traditional university accounting programs. Why? They need data analytics people. They need valuation experts. They need all kinds of things that we have never really focused on in the traditional accounting program. And that force just carries on all the way through to the audit process and eventually into the financial statements. So I'm happy to get into more examples, but I'll let you ask another question and we'll see where this goes.
Sure. Well, let's flesh that out. Let's talk specifically about audit failures, right? You keep hearing about that. And obviously it's unfortunate. I mean, I give many talks on this, and sure, Enron makes headlines and so forth, but you don't hear about the thousands upon thousands of companies that get audited without any problem.
Right. And empirically, from a research point of view, the error rate without considering market caps, that's a very important caveat. Without considering market caps, the error rate is less than 0.01% in the United States and pretty much anywhere in Western Europe. And so, I mean, one out of 10,000 audits or failures. That is a pretty good hit rate, to be honest. The problem we see is that when that one is Enron or Carillion in the UK, that it becomes important way beyond the likelihood of it having happened, because we know that something's going to happen. The audit risk model that we rely on to make our decisions assumes that there's no such thing as perfect audits. There's no such thing as zero risk in an audit. We can't predict the future perfectly. We cannot trace down everything that may exist that's not actually recorded, because that's trying to prove a negative in a philosophical sense, which you cannot do. So there's always going to be the case that falls apart. The problem is when you combine things falling apart with the incentives to make them fall apart, you tend to get into an environment where the problems get very big. And that's the thing is, the incentives don't really change, right? I mean, humans are humans. I mean, we haven't solved venal crimes like, basic murder, for that matter. To expect that we're going to solve complicated financial crimes completely is probably naive. And so the challenge to us is to obviously figure out what the cost benefit balance is and keep it at a de minimis level as much as humanly possible. It's not like management gets up in the morning and says, this looks like a good day to commit fraud. Oh, and by the way, they're not going to tell the auditor. I mean, they're not going to come in and say that to the auditor, right? And so there's always reasons why these things happen, often based on incentives, often based on the riskiness of the environment. The phrase I occasionally use, which is very much a U.S. centric, is it's kind of like a California philosophy. Why do good people do bad things? And it's usually because of stress in the environment, the pressure that the management positions and the performance of an organization put on individuals within a firm. And so as a result, what often people who wouldn't necessarily think about doing things end up doing things, and they can rationalize it because it's usually very small. It's a small thing to start. And many frauds start as a very small non-material activity to make sure we can cover, we can hit our sales targets for this year by holding the sales book open for 2 days or something. The problem is it snowballs, because what happens this year then gets bigger next year, and eventually it gets out of hand. And in most cases, as far as the ones we see, we don't know what we don't see. So those haven't changed. Those forces haven't changed. What has changed is technology. Fraud schemes are not very complicated in many cases. If you reduce them to their core essence, they're not complicated. But the technology can be very complicated. And so I'll
What
give
do you
you
mean
one.
by that?
Yeah.
Yeah, what do you mean by that?
Okay. Hiding debt, right?
Yep,
I assume this is something that investors would care a lot about.
for sure.
And it was a major
Big
element.
part of Enron.
It was a major element of Enron. That's why they set up 4,000 or 3,500 special purpose entities.
Yep.
And it wasn't just hiding debt; it was hiding losses. Which, by the way, a lot of people don't realize a lot of those losses were coming out of a technology division, where they were basically managing a technology website that allowed telecoms to swap capacity on digital networks, and they were losing money on that. Those swap transactions actually were a whole nother problem, but that's another cast of fraud. But I won't get into that right now. I'll talk about the so hiding debt. Okay, well, we know that companies may want to hide debt, so why can't we just audit that and have it never happen again? Well, last year there was a case. Now, granted, this was in Brazil, but basically, if some of you may have encountered something called reverse supply chain financing, which is essentially a transaction that says, okay, I'm a retailer and I buy from a supplier, and the supplier gives me payment terms. In classic accounting lingo, we also call it 210 net 30. Pay in 10 days and you get a 2% discount. Otherwise, it's due in 30 days.
Yep.
Okay, well, the retailer says, I don't want to or I can't pay in 10 days, so I'm going to lose the discount. So what happens is a financial intermediary comes along and says, wait a minute. We will pay the supplier on your behalf. We will keep the 2%, and then we will extend to the retailer a 90-day payment window at some interest rate. So in a sense, both the retailer gets to save some of that discount, and the financial intermediary gets to save the other part of the discount, and the supplier is made whole. They don't even have to, they don't have anything to do with this. Now, that is a very efficient way to finance trade payables to your suppliers. So what was going on, but here's the challenge. You've got three parties. You got a retailer, you got a supplier, and you got a financial intermediary. What if they're in three different countries? Normally, the way an auditor would approach this is to simply send a confirmation to the bank and ask the bank, does our client owe you this money? And there'd be some other questions attached to that. And the bank would, unless they were actually involved, which would be extremely rare.
Parmalat.
Yeah, Parmalat, very good. Grant Thornton and the Cayman Islands.
Yeah.
And so they would send back the confirmation saying this is how much the company owes, blah, blah, blah. Okay, well, in this case, this reverse supply chain financing transaction is being financed through a financial intermediary that may not be a bank. What it may be is an electronic platform fully enabled by blockchain technology, where the other side of the transaction is anonymous, because that's the whole point of blockchain transactions, is you don't know who each party is anonymous to each other. And then how does the auditor find out the company's doing this? If the company doesn't tell the auditor, okay, so now you got a situation where the auditor doesn't know the transaction exists. It's over the horizon, in a sense, it's out of their immediate purview, and they don't even know who to contact to verify it because of a smart contract that's blockchain enabled that this is done through. This is the brave new world of auditing. Traditional audit trails break down. Traditional information sources are no longer the ones we relied on. And so this is the thing the auditing is wrestling with. Okay, now, again, the scheme is easy. It's simple. Hide your debt. The technology is very complicated.
And so this is happening, and this is, of course.
And that, by the way, that was a $6 billion fraud.
Yeah. Sigman. Well, that was what was it called? Americanas,
yeah.
Yeah. And but the blockchain technology, that takes us to the other major fraud in the U.S., which was the Sigman Fraud problem, right? Which you were alluding to.
You mean the man, the boy man with mama problems?
Yeah, yeah.
Yeah,
Oh,
FTX.
but this is what is amazing is this is not the first time, right? These, as you pointed out, the hiding debt. And this issue of supply chain financing is something we've been writing about extensively, teaching and explaining how it works, because most investors aren't even keeping up to speed on this. And we identified a company, Advanced Auto Parts, that is using this extreme to levels of extreme, such that its debt goes up 2 and 3-fold compared to what it actually shows. So
Yeah.
what do you think auditors need to do and the profession needs to do to deal with these type of situations, to deal with these issues?
First of all, let me go back to the FTX case, because if you remember, I had a slide in Toronto that
You did.
culminated in FTX, but let me read it. I mean, I just pulled it up to refresh my memory. It's a series of conditions, and the point of this was, who am I? What is this famous fraud? And basically, it starts off with, you create intangible or non-possessable assets you cannot take possession of, that have tremendous fad value, that are traded in a non-traditional market.
Sounds like tulips.
Usually by low information investors, subject to limited regulation or oversight, and influenced by current economic trends, subject to market manipulation. And the punchline of that slide was, it's FTX and what they were doing with cryptocurrencies. Except it's not just FTX. If you turn back the clock, it's the global financial crisis, with essentially retranching junk bonds and credit default swaps. You go back further than that, and you can see other conditions where this has happened, going all the way back to a case involving a company called ESM Government Securities, which was actually in Fort Lauderdale in Florida, where that involved early days of repurchase agreements. Now, you think about a repurchase agreement. Essentially, the idea is, I buy something from you today and you agree to buy it back in a couple of days. I don't necessarily take possession of it when I buy it, because I'm just going to give it back. So now you have a asset that is non-possessable, or not possessed anyway. And what keeps the broker from selling that same asset to somebody else who's also not going to take possession of it? Or even worse, how do you know the asset even exists, which in this case was a treasury note? How do you know it even exists? And then, as Anthony alluded to, this is actually the Dutch East Indies tulip bulb problem from 1637. And so, again, it comes back to the idea that the fraud scheme is actually not complicated. You puff up the value of an asset, you dump it, you play a shell game with it, and eventually the market collapses. And so the technology gets complicated, and the auditor has to keep up with that. So you ask me, how do you deal with that? Well, first of all, I don't think it's going to go away. And part of the problem is the auditing profession, is always playing a bit of catch up here. It's like the old joke about the military always fighting the last war, which is a very unfortunate type of story to be telling these days. But it's kind of the same thing with auditing. We tear apart and study to death Enron and Carillion and the global financial crisis. But a reasonably intelligent fraudster isn't going to do the same thing that the last guy did. And so I think we need a better vision to figure out where these risks come from and where they're going to go and how they may manifest. And that requires a much more fundamental core understanding of an organization and the pressures it's under and how it's doing things. So part of this is that we need a culture change, I think, in auditing. It's not your grandfather's audit. It's not your father's audit. It's not even my audit anymore, to be honest. It's something that is much more directed and challenging. Now, what do we hear? Oh, technology is going to save the day. If technology creates the problem, technology can solve the problem. Okay, AI, right? Everybody's favorite.
Oh yeah.
We're save the day technology, AI.
Smells like tulips.
Yeah.
Like
well, AI is not, may not be as reliable as lots of people think. Lots of people like to play with it. In fact, my boss last year wrote my annual evaluation using AI. It said I deserved a big raise, so he threw it away. But anyway, the issue of artificial intelligence and auditing is a really challenging one, because the official position of the regulators around the world is it's not audit evidence. And the reason they won't accept it as audit evidence is because it's not reproducible, right? They can't come in and do an inspection of the audit 2 months or 6 months later and verify that what's in that report is actually what came out of the artificial intelligence. Because by then, and the other thing is they don't know the data sources that necessarily went into the report. And so all of a sudden you have you're putting a lot of reliance on something that cannot be verified by the auditor and therefore not by the inspection. And so we got a lot of problems that we still have to challenge here. The other issue is data analytics, big data. This can be an incredibly important tool, but we have an obstacle. I mean, you think about it, an accounting firm, an audit firm, take one of the big four. They've got thousands of clients. The data they have potentially available to them inside organizations is massive. But current ethical standards say that you cannot pool that data across the client base, right? You cannot share what you learned from one client in evaluating another client directly. Now, the other clients aren't going to see this data because it could arguably be put into a secure database and used only by the audit firm to do statistical analyses. But technically, I've been told they're not allowed to do that under current auditing standards and regulations. So there's some barricades here, barriers to where the auditors can go with some of this stuff. But it's not stopping them from working on it. They're working on the issues. We just hope that the regulation catches up at some point. But in the end, I don't think it's actually rocket science. You have to look at an organization and ask yourself a series of questions. I always tell my students, the first question you have to ask is how does the organization make money or plan to make money? Because obviously they're not all going to make money. And if you don't actually understand that answer, then you probably are not ready to audit that organization.
Love it.
You will not know what rocks to turn over and what corners to look in. And the reality is Enron wasn't, and it was officially an oil and gas company, but really it was more of a high-tech company with an oil and gas auditor. And that was part of the fundamental problem. So you need to understand their business model. And does it make sense? The Theranos case with, what's her name? Elizabeth Holmes?
Jones, yeah.
I think if you looked hard at that, you'd begin to understand that was not a viable business model.
Yep.
The next question I think we should be asking is it too good to be true? I mean, and this is for investors as much as anybody, right?
Yep.
We tend to hop on that bandwagon, often because of these things I was talking about with fad assets and stuff like that.
Yep.
We hop on those bandwagons. We buy into the puffery. The third thing we have to ask ourselves, is this really too complicated to understand? Right? Is it so complex that we actually can't see where this is going? That is, in my mind, a very serious danger. Finally, other than being a basic contrarian, which I think is good for an auditor and maybe some investors.
Investors, yeah.
Is basically know the people involved. Know the people involved. There are, the individuals and organizations, particularly at higher levels, often have histories that they bring along. And so that's very important to understand. And the thing is, the auditors have the ability to sit across the desk from these people and actually, it's old fashioned, say, look them in the eye. And we're back to in-person audits, because Zoom audits don't work in that sense.
Yep.
What you see in a Zoom call can be highly scripted. What you see sitting in somebody's desk is much harder to script. You see the body language, you see the twitching foot, whatever, and
all the signs of if they're lying. Yep.
Right. I mean, I've heard people talk about what will be, auditors should get more like FBI training for detecting lies. I'm not sure if the firms have done any of that stuff, but they should at least have some experts that do that. And there's things that the firms can be doing, but part of that is we're accountants, right? We don't actually like to evaluate other people. it's hard. It's hard to
Yeah.
sit and say, okay, make a judgment about how somebody, what do you think their motives are? What do you think they're
Yeah.
capable of? And traditional auditors are not trained very well to do that, but it's a critical potential skill set. So, I've been talking about this for a while, and I think the firms they talk about professional skepticism. That's the channel through which they try to develop that skill set, and they're definitely getting better at that because of the emphasis on professional skepticism. They didn't feel like I can understand why you don't feel comfortable being told to figure out if you think somebody's lying.
Hmm.
But if you're told you need to exercise professional skepticism, now you have a perspective that actually makes sense within the professional context. You know,
So,
police decide if people are lying. We don't have that. Doesn't seem like part of our job description.
but it may be, if I might package your four key things to look out for, and I'm going to extend this with your permission. You did make a reference to this, but I think this is really the same sort of questions that investors need to ask when they're faced with um, uh, typically a new concept, a new business model, something that's going to be that's going to revolutionize an existing construct
Mhm.
or sector or business model. And so I always like and this is similar to the structure we use. So it's so great hearing you say it. So how does the company make money? What's their business model? I like to say a company basically puts money, gets money in, puts money out. In between, there's some value creation. And so what is that value creation?
Right.
How does that happen?
Yeah.
I love the two. Then is it too good to be true? Are you buying something? Can you buy into this puffery, as you called it? I love it. Is it too complicated to understand? And we've seen so many situations where it's like, why do you make your business so complicated? I remember sitting in front of BioVale, right, like the CFO, the C and the and the and the IR person telling me how great their business was. And I said, then why are you cooking the books on the side? Like, if it's such a
Mhm.
great business, why do you capitalize R&D and capitalize your advertising costs and not tell anybody about it? Like, it's a great business. Let's make it great. Let's make the accounting great.
Mhm.
And then the last thing you said, know the people. And it reminds me of so we've had a private investigator here on our show, Chris, and his name is escaping me now. It's killing me, but he's worked for the RCMP and the border control and so forth, and he has this saying that says people run companies. So if you follow someone around and they kick their dog, they don't get along with the person at the restaurant, they can't stand their neighbors, all this sort of thing, they typically probably have characteristics which spawn into their business.
Mhm.
And so I love those comments you had. If we had to pull this even a little bit further, what is it that can help tweak those skills? Because again, I'm going to take this. Obviously it's the auditor, but how can investors tweak these skills to become more skeptical? Because everybody.
Well, there is. I mean, there's training of that you can obtain training along these lines. I mean, the firms, the big four, five, four. Keep dating myself.
Yeah.
I'm old enough to remember the big eight firms. Anyway, the firms do training on it, and clearly, when you look at law enforcement, they go through training to do these sort of things. Um, yeah, it's I like I use a quote often, and I have to paraphrase it because I don't have it in front of me, but it was by Adam Smith. Remember the father of capitalism?
Of course.
And he said something along the lines that people overestimate the chance of gain and underestimate the risk of loss.
Yes.
And that's a natural human instinct. And this is a guy that believed in markets and things like that. And he still believed that the individual matters because markets are made up of individuals. Because in the end, the market trade, that marginal value was the last trade, right? So that was some marginal market. I don't mean marginal as in trivial, but marginal investor who made that last trade.
Hmm.
And so it's not, in the end, we believe in equilibriums in markets and inform markets, but individuals matter quite a bit. And we can then see what hurting it happens when all of a sudden something comes, a new piece of information, and everybody goes chasing that, and it's called herding in economic terms, where everybody goes in the same direction based on that information. Uh, and that's where I say the contrarian instinct can kick in a little bit. And you step back and, now timing is everything. And when in the if you're going to invest on timing, I don't know how to deal with that problem. I'm an accountant, so I don't deal with timing driven investments. I deal with value driven investments. And so, this is the sort of stuff that you can learn a little bit about how to read the signs and why I'll come back to auditors, because the auditors are in a very privileged position. I mean, an investor gets to see, the annual meeting, they get to get on the conference calls, which is basically typically a passive activity, right? Where you get to absorb information. But an auditor gets to sit in the middle and have these conversations in theoretically an open-ended manner.
Yep.
And not just with the executives, but with the people in the trenches. I'll go back to an example, my prior example in Prague with the bank. We were evaluating the internal control over the foreign currencies. The particular bank we were looking at was, under the communists, was the only bank that could have foreign currency reserves. And so they had to manage that. And this is before the euro. So there was, however many dozens of European currencies, let alone the rest of the world. And I talked to these people how they managed their foreign currency, and they talk about the traders and how they entered in the system, any trade they made. And they had, limits on various currencies. And I spent a day talking to all these people, finding out how to do this. And finally, I found the person who was in charge of the system, who happened to be like a 60-year-old lady in the basement who kept a spreadsheet and would once a week update the currency balances based on a pile of papers that she was given. That's not going to work in the world of foreign currency trading, right?
Yeah.
And so that's the thing auditors get to do. Do they always do that? It's not clear to me they do. Now, why don't they? Now, that's also very complicated. Accounting firms are commercial. They need to be able to make a profit. Audit fees tend to be driven down because, I won't go into bore you with all the economics, but they tend to follow a commodity price model, not a value price model, which is really unfortunate. And then I think the regulators have to wear a hat here, because regulation tends to focus on compliance with standards rather than finding the right answer. I mean, I'm sure your audience has seen reports put out by the PCAOB and the Canadian regulators saying that 30% of audits are failures on a year basis. Well, the reality is they're not. They are actually technical deficiencies. But if you look at the number of audits where they've actually got the wrong numbers, or they have to change the auditor's opinion, in the United States, you can count them on, in 20 years, you can count them on the fingers of one hand. Where the number of cases where there actually was a substantive error in the financial statements because of the technical error in the audit work. So most of these things don't ripple through to what we would call failure. They're deficiencies, and we want auditors to do better, because the deficiency could become a big problem. But the reality is it's also a learning and training exercise, and I'm not sure publicizing it as a failure helps the profession or the regulator, to be honest. So, I mean, this is we're in a very complicated world now. The ecosystem of the audit world is very complicated now. So I'm not sure. I've lost my train of thoughts. I'm going to turn it back to you, Anthony.
No, that's fine. Look, you're right. But everyone needs to play a role, because I think you touched on this, and I've said it a number of times in presentations I've given. So it's very easy to say, oh, the audit, it's like oxygen, right? You don't know how much you need it until you don't have it. So you imagine a set of financial statements that didn't have an audit. Yes, there's problems with audit, but it's kind of like you just accept it. No one actually reads the detail of the notes, not the notes, but of the audit of the audit opinion.
Mm-hmm.
And now I think with the CAM, in where you're going to get key audit matters or critical audit matters here in Canada, and that's actually, I'm encouraging investors to read that, because these are the areas where we had pushback or had to do extra work during this audit. Basically, giving you a roadmap of where the risks are.
Right? Well, in theory, that's true.
Yeah.
In practice, maybe not so much. I was actually moderating a session for the PCAOB last year at a conference where we had 4 investment representatives, 2 from very large venture capital funds. One was the head of a major state teachers pension fund, and I forget who the fourth one was. And we went through, this was all the investor's perspective. And one of the things they pointed out was they felt CAMs, whether it's with a C or a K, was a massive lost opportunity, because what's happened is they become boilerplate. Because what people fail to think about is the audit report is a legal document as much as it is an audit document, which means it goes through rounds of legal review. And so when they changed it and made it a longer report by putting CAMs in, now the lawyers are going to read this thing with a fine-tooth comb, because one thing, I think the firms were paranoid that they'd send out reports for companies in the same industry with different CAMs, and that could be used against them. This is the difficult side of solving some of this problem. It's like, yes, the auditor knows a lot, but they have very few channels in which they can communicate some of this information. And until Sarbanes-Oxley, for example, it was not even the auditor, even if they discovered fraud, had no channel of communication.
Yep.
Their obligation was to go to management.
Yep.
Sarbanes-Oxley now provides a channel to the SEC. I remember in the Netherlands, there was a big case called Ahold, which is a grocery store chain, huge audit failure. And I happen to know the audit partner of the firm who discovered it. He rotated in and replaced, it was the same firm, different audit partner. And he found it. And he was telling me he had nobody to tell it to. And he got sued, of course. And they said, basically, we filed all the formal communications we were legally allowed to do. Because what you can't do is call up the Wall Street Journal and Financial Times, right? Mm-hmm. That would be violating client confidentiality. Now we're getting new channels for this, and for this kind of thing. And by the way, back to an earlier point you made, I don't talk about audit failure anymore. I talk about system failure, because you've got the audit committees, you've got the board as a whole, you've got the internal auditors, you've got the internal control system, you got management, of course. All these are moving parts within the financial reporting ecosystem. They all have a job to do. And we have this traditional assumption that the auditor can compensate for a breakdown in any one of those. And I would argue that it's probably, with technology particularly now, it's probably not. The auditor cannot probably compensate for every one of those potential breakdowns. So when you have cogs that don't work to their potential, for example, an audit committee that is too differential to management, all you've done is shift the deference from the auditor. We talk about auditors being too differential to management, but now you've shifted it to the audit committee and they're too differential. And maybe the auditor actually doesn't even observe that the audit committee is being differential to the management, because now it's a second order effect. And so these things, it just comes back to, it's very complicated. And I'm amazed that auditors do as good a job as they do, to be honest. I mean,
would you agree that, as I listen to your examples and your theories, that understanding people and psychology is probably as important as understanding how to read financials?
Yeah, I think it's a major point. Business, I'd say there's three legs to this stool, and it's not the fraud triangle. It's the business model, it's the knowing people, and it's knowing the accounting side.
Yeah.
And you got to, auditors certainly have to be able to handle all three of those.
As do investors, if I can just make that plug. So I'm going to wrap it up here, because we could go on forever on this. If any of the participants have a question, just put it in the chat here. We're trying a new platform here in WebEx. We normally have done these on Zoom. We're going to try WebEx because more of our clients can use those. Use it, they tell us. So if you want to put in something into the chat, I'll make sure to ask Robert the question. I'm going to leave you with a couple of key questions I always ask our guests. The first one, your favorite book, aside, of course, from your text.
No, I don't read that. I mean,
or
every 4 or 5 years, I've got to go do it again. So no, in between, I don't look at it.
Okay.
To be honest, I only teach graduate students now, so I don't even use my own book in it for my own class. But because I have to read so many manuscripts, I tend to be an escapist, so a good spy thriller, or even better, a good English, British historical novel. That's my plain reading. In fact, right now I'm reading something by Bernard Cornwell called The Last Kingdom, which is basically the foundation of the England with the Saxons and Vikings. But so that, yeah, and now whatever that just told you about me, I'm not sure, but I'm not going to worry about it.
Oh, that's fine. And then of course, because I'm a big breakfast guy, your favorite breakfast meal, and if you have a favorite restaurant you want to pitch.
Oh no, that's really easy. Having just got back from New Zealand, I am a breakfast person actually, and in New Zealand, any decent cafe you go in is going to have on the menu something they call the big brekkie, big breakfast, and
Yeah.
it's going to be eggs on whole wheat on some kind of very nice toast with bacon, what they call streaky bacon, which is not to confuse with the bacon that still has the big round part on it. Something called Kransky, which is a sausage with cheese in it.
Wow.
Hash browns, baked tomato, creamed mushrooms, and because they have an English history, baked beans. I usually order it without the baked beans. And you can go any Auckland, any New Zealand cafe would work for that. If you want me to bring it home closer to home, there's a cafe down the street where I go to occasionally when my wife lets me eat eggs.
All right. Well, listen, Robert, that was a wonderful discussion. If you could be a little bit of a prognosticator now and look forward, 10, 20 years in the profession, and you could give some advice, what would that be?
For me to retire. uh, well, I mean, the accounting firms have a major challenge. I mean, the world has changed radically. This is why I say it's almost a perfect storm for them. One of the things that they're wrestling with technology.
Yep.
As we know, I'm sure your investment community knows, investments in technology are expensive.
Mhm.
And so the business model of the firms is being challenged because if you're a partnership, you have to come up with the free cash flow to make those kind of investments, often in the billions of dollars, by collecting it from partners, individual partners, either through retained earnings. And accounting firms in many countries can't retain earnings because of tax reasons, because they're a
Mhm.
flow-through
Or
organization.
partnership. Yeah.
Yep. And they can't take on outside investors, and there's only so much debt they can raise from banks. And so this becomes a real challenge for them going forward. But I think I'll prognosticate two major things because of things I'm actually doing with the international regulators and the European Union. One, sustainability assurance could be a major contributor to the lifeblood of an accounting firm. Right, we're all seeing sustainability reports. The United States is a little behind on this because the SEC, it's got to come from the SEC, and we know anything coming out of the U.S. government, particularly from a legal point of view, is going to be slow going. EU is way down that road, and I think next year, effective maybe it's this year already, they have mandatory sustainability assurance.
Next year. Yeah.
Next year, yeah. So now, who's best positioned to do that? This is what I'm doing with the EU, because the EU realizes that even though the international auditing standards have now been written to apply to sustainability assurance can be done by engineers, lawyers, anybody, basically. And they don't have to follow chartered accountants rules,
Mm-hmm.
which means they could theoretically write their own standards. So the EU is wrestling with that question, how to make sure that everybody's up to a high level of assurance standards. And the accounting profession has, I think, a couple of very major advantages. One is we have a culture and tradition and history of verifying information. It doesn't have to be financial. We know how to assess risk controls, gather evidence, and come to a conclusion if numbers make any sense. I think we actually underplay that as a value generator in what we do. The other thing we have is a culture and tradition of independence that I don't think any other profession really has. So, some other profession coming in and having to follow chartered accountants type rules would have a very huge upfront cost to do that. Where we probably have the least of advantage is in subject matter expertise, but that's probably the easiest to obtain. You just go out and hire some subject matter experts. The other thing, and this is even more pie in the sky, but I'm having these conversations with an organization called the Public Interest Oversight Board. whether the structure of accounting firms are fit for purpose in this market. I learned a very interesting fact from these conversations. I forget the exact number. I'm going to make up a number, but it's in the ballpark. That PwC, PricewaterhouseCoopers, has almost 450 client-facing entities on a global basis. How do you control those in a partnership? Particularly one where the partnerships are national, and the international network is simply by contractual arrangement, not any direct ownership or management control relationship. And so I think you're going to see that there's going to be a change in the nature of firms' governance and firm structures. And I have lost Anthony. I'm not sure if you lost me or not.
No, I'm right here.
Okay. Oh, there you go. You're back. So I think that's a little longer distance and more pie in the sky, but I think they're both very relevant to where the markets go and how investors are going to have to be dealing with the changes themselves.
Well, Robert, thanks for your time, your wisdom, your expertise, and
My pleasure. Thank you for having me.
we'll stay in touch. Thank you, and
Very
thank you
good.
everyone for joining us. Stay strong.
Thank you to everyone who I can't see, but I'm glad you came. Thank you.
Yes.